Hello and welcome to our final webinar of our Market Intelligence series with Zonda. As a reminder, this presentation contains no forward-looking statements. With that, I'd like to thank all our builder and manufacturing partners for joining the call today. We really appreciate all your partnership this past year and are looking forward to working together here through 2023. I'd especially like to thank our partner Zonda and Ali Wolf for working with us on this series. We hope you found it informative. And if you, as a reminder, if you do have content that you'd like to see and potentially have us do this again next year, please send it to us. We'd love your feedback and appreciate your time. With that, I'd like to introduce Terry Schilmoeller, our VP of Ready Frame Solutions. Terry?
Thank you, Mike, and hello to everyone on the call today. I have just a few slides today to present as I talk to you about ReadyFrame. So ReadyFrame, if you're not familiar with it, I'm sure that most of you are, is a computerized pre-cut framing technology that we put you ahead of the schedule and of the competition. And how it works, each piece of dimensional lumber is precision cut by proprietary saws in our off-site manufacturing facilities. The ReadyFrame system ships the smart bundles, compact, pre-cut, and labeled, ready for your framers to assemble on the job site. At BFS, we used a builder's 2D plan and create a 3D image for review before the ReadyFrame process is put into motion to precision cut the ReadyFrame components to within a 1/16 of an inch. We put the builder's dollars that they have spent on architectural drawings back to work for them. This works for single-family residential builds. It works for multifamily builds. In fact, in the last 60 days, we've picked up a number of multifamily projects. Light commercial, meaning hotels, it works very well. 55 plus communities, and most custom applications where the home design has been finalized. The benefits of this process, number one, would be less field framing labor involved. Quicker, easier builds, increased product efficiency per hour of build time worked, fewer errors and less risk, less ladder time and saw time for a safer project, and reduced job site waste. Next slide, please. So in 2019, Builders FirstSource had a third-party independent study done where we calculated the benefits of ReadyFrame. Some of the percentages that I can share with you today would be the less field framing labor amounted to 33% fewer framers that were needed on a given job site to complete the project. Of those framers that were on that job site, their productivity per hour was increased by 39% per worker. Their ladder time and saw time was decreased by 27% on the job, and the reduced job site waste amounted to 66% fewer dumpsters that were hauled on a given job. Next slide, please. So this map is going to show you the different locations where ReadyFrame is located today across the country. We're located in 36 locations in 19 states, with new locations coming in 2023. We'll be working towards Florida and Arizona in order to accomplish our ReadyFrame footprint across the United States. Thank you for your time today, Jack.
Terry, thank you very much. And if you want more information on ReadyFrame, you can find it at our website at bldr.com. With that, I'd like to introduce Ali Wolf, the Chief Economist from Zonda. Ali?
Thank you, Mike, and hello, everyone. I am excited to be back today to go through the state of the housing market and wider economy. And as I was talking with the BFS team, we saw that there was a high level of registrants today because I think everyone's just trying to make sense of how this market is changing and how quickly it's changing and how it very much depends on where you are. And so know that today's focus of the presentation is to look at what's happening in the market by a market view, by looking at what's happening at different price points, and also by digging into each of the different regions. You are going to see some very clear and very massive differences if you look at the different regions. Anyone that tuned into Zonda's housing market update presentation would have seen some of the regional highlights. We've updated that data since then, and you'll see even more differences compared to where we were. Now, as Mike said, I am Allie Wolf. I'm the chief economist with Zonda. If you're not familiar with Zonda, we are a housing data and consultancy firm. We track the entire building life cycle. We're looking at what's happening with raw land, and as land goes through development, know that I'm not going to show that many land stats today because our data comes out quarterly. The new data will be released at the end of this month, so we will have new stats coming out soon. But then we track all of the actively selling communities across the country, which is where you're going to see more of my focus today. What's happening with the actively selling communities on the ground, what's happening with pricing, and ultimately what's happening with inventory today, not the land side, but the broader inventory discussion. We have 45 minutes to go through 5 sections. I'm going to go through that current backdrop, which is really picking up where we left off the last time we did this webinar. Then we'll talk about the regional highlights that I mentioned. We'll talk about the builder response. If the market is different than where it was over the past couple of years, how are builders responding to try to encourage more sales? We'll talk about supply, and then we'll finish with our final thoughts and things to think about from a strategy point of view. So starting with that backdrop, what we do at Zonda is we have experts across the country. You'll see me call out quotes from some of them later in this presentation. We get on a call each month and we just say, hey, what are you seeing on the ground? And we do this to really say what is different and what is similar. So on this slide, we really have a lot of the similarities seen across the country. I think one of the biggest things is just preserving backlog, is to just make sure that people that were excited to purchase a home over the past 9 to 12 months are still very excited to go through with purchasing their home. We have found that incentives are extremely common right now, both from a backlog perspective, especially if someone had committed to buy a home and they didn't have a rate lock. So we're seeing some of those mortgage rate buy downs really effective in the preserving backlog discussion. And then also just figuring out what makes the most sense to encourage additional sales. And what we're finding is that the builders that give their sales teams the most flexibility to say, well, who is buying, why are they shopping, what's the biggest pain point? Those are the incentives that are most effective. It's not a broad brush. It really depends on the person. From the resale side, you'll hear me mention a lot the role of resale inventory in today's presentation. I think the best thing that we're seeing on the resale side is we were at this point where resale sellers thought that they could get any price for their home no matter what. And I think we started to realize that that's not the case. You can't continue to sell for 15% more than your neighbor. And so there is some realization that's coming from the resale sellers, which I think is good when you try to talk about some kind of return to normalcy in the market. You've heard me mention a couple of times consumers. They're definitely showing sensitivity to what is happening right now. And I'll talk about a couple of the biggest concerns that we're seeing from the consumer point of view as we go through this. But the backdrop is similar to what I talked about last time, the fact that when you're in a market that mortgage rates are rising very quickly, it's no surprise that our industry is one of those that is going to slow the most. So we saw that mortgage rates move from 3% to now over 7% just throughout this year, so I guess in 10 months. And as we look at this, the resulting impact is that a lot of that froth, a lot of the unhealthy parts of the housing market that I think we all understood weren't going to continue forever have come out. And existing home sales now, 90% of the market are back to where they were, just below where they were in 2019. Very similar when you look at our data at Zonda for the pending sales index. This is us tracking contract sales activity. And again, we're just below 2019 for the overall national level. The reason I'm highlighting 2019 is for us, that was an awesome year for housing. It was a year that we were selling homes. There was home price appreciation. We did have a need to bring more product to the market, but it was a lot more healthy. If you remember over the past couple of years, people were camping out. Interest lists seems like they could never run out. And those dynamics have shifted. As we look at that data, know that right now the publicly available data is for August. Many of you know that we also do division president surveys to try to get more real-time stats. What I'm showing you here are the results from our September survey. As we're talking right now, we're in the middle of collecting our data for mid-month October. So there are a couple data points as we go through this presentation that I'll call out how October was a little bit different than September. But most of the discussion here is going to be September stats. And as you can imagine, we are seeing that the majority of builders are saying that demand is slower. In some cases, again, it's slower, but it feels very seasonal. And you'll see how that looks by market. And in some cases, it says, hey, you know, the builders are saying, yeah, it does feel slower. It feels slower than normal seasonal levels as well. We have about 20% of builders that are still saying that demand is on track with what they expected or stronger. Now, like I showed for the last slide, we talked about what we were seeing with overall sales from August, from new and existing. As you look at September, we have 15% of builders that said their sales had actually increased month over month. 34% said their sales were flat. And then we had about 50% that said sales activity had slowed even more from those August levels into September. But this becomes, and this is where we start to talk about the differences by market and by price tier, it becomes a very unique story. So any of the markets to the left of the dotted line are underperforming 2019, any to the right are outperforming. You'll hear me reference these numbers a little bit later as we go through the regional, but I thought high level, I wanted to refresh the stats that we showed last time we met. So on the right, you're seeing that markets across the Midwest and the Southeast are outperforming. There are some markets where it's just difficult to get more homes built, like places in Philadelphia or LA, where you're seeing that outperformance compared to 2019. On the left-hand side, Phoenix, Sacramento, Las Vegas, Denver, Riverside, Seattle, Austin. These are markets that over the past couple of years, when you showed where did we see some of the highest levels of home price appreciation and where did you see some of the most positive domestic in-migration, those markets fell to the top. They saw a lot of reasons why home prices went up, a lot of new buyers, inventory went down. But when those prices went up so far away from income levels and with interest rates over 7%, we're finding those are some of the markets that have retracted quicker than others as well. So like I said, consumers are responding to what's happening, and I think we should not be surprised by this. The two biggest issues right now, which are the same they've been for the past handful of months, is buyer confidence and qualification issues related to the mortgage environment. So hesitancy from buyers, that will range from some people just saying, you know what, I'm not sure where this market's going to go, so I'm going to maybe just sit on the sidelines, which to me is a really good opportunity that we'll talk about a little bit later. We also have some buyers that are saying, you know what, every time I open the news, all I read about is the impending recession, so maybe I want to wait. But in some cases, people are just saying, I would still love to own a home. As I showed last time we met, we have a record number of buyers that still are interested in buying. They're just trying to figure out how do they navigate this environment. Where if you look at resale home prices, these numbers to me are amazing. This is looking at since February of 2020, what has happened to resale price appreciation per month. So I think we all understand that wages have gone up. But if you subtract out wages from inflation, we know that wages have actually gone negative. At the same time that across a lot of these markets, home prices were up between $5,000 and $8,000 every single month. And if you look at the math, moving from a 3% interest rate to a 7% interest rate is the same as $800 more per month for that average monthly payment. And when I look at these stats, we do know that there are still homes being sold across the country. And so what this tells me is when we're looking at prices that have gone up this much, and when we look at the monthly payment that has risen so quickly, the big question is, what is available on the market that makes people want to move? I think the big part of today's presentation is the why. We're finding some builders are choosing to down spec their homes because they're saying, hey, we know that the monthly payment's important. We're trying to keep the average sales price reasonable. So we're going to take out some of the bells and whistles in the home to help address the affordability concern. We have other builders that are saying the complete opposite. They're saying, well, our competitors are really down specking the homes, but ultimately, if consumers are going to pay more, they want to know that what they're buying is worth the money. So we're having some builders that are doing the complete opposite and saying that they're up specking the homes. They're trying to make the homes as aspirational as possible. So if someone's coming and shopping, they're saying, wow, there's a reason that I want to go through with this purchase. Now, as we talked about last time, we know that what is happening to consumers based on mortgage rates depends on the consumer. Because if you're a cash buyer, you don't care that mortgage rates went from 3 to 7%. If you're a buyer that is buying a home based on your income, you don't have much else wealth to tap, those buyers are the ones that are showing the most sensitivity to today's market. To me, this is also the buyer group that has the most opportunity because for the past couple of years, they weren't able to buy because the market was so competitive. And then where they are today, they can't buy because now affordability has gotten stretched, but you still have this large pool of people that are interested. But for now, we're finding it's that entry level, that lower third price point that is actually showing the most significant pullback. As we look at the lower third right now, we have 23% of the top markets that have a sales rate performing above where it was last year. As you look down this list, there's a couple markets that probably stand out to you, actually 4 that really catch my eye: Las Vegas, Phoenix, Seattle, Sacramento. Those are some of the markets, again, where you saw some of the most massive run-ups. But what happened was that lower third, that price point of the lower third, in some markets used to be 300, now it's 500. So to go from that kind of gap, you have seen that some of those consumers respond accordingly. Not entirely the case when you look across the middle third and the upper third. These are some of the buyers that have more wealth to consider. And yes, there have been fluctuations in the stock market and not everyone is willing to tap their stock holdings, but we have seen that there's still some outperformance compared to where we were in 2019. Just take a look at that bottom chart. That's your upper third. This is if you're looking at we call it the high-end market. In Tampa, in Las Vegas, in Raleigh, in Jacksonville, in Charlotte, in LA. I can read down this list: Chicago, Salt Lake City, Seattle. You're seeing that there still is that outperformance. And that's why when we're looking at today's market, I said we can look at markets, but we also need to dig into that and look at what kind of buyer groups are buying and what's their motivation behind their purchase. Which is where I want to take the discussion over to the regional highlights. So at this point, you probably have a sense of how the regions will break out by the outperformers and underperformers, but I want to take it even more detailed than that. We're going to start from the Pacific region and move over east. I will tell you that the first 3 regions will not leave you feeling overly positive. The next 3 regions tell you a very different story. So it will again depend on the market within the region. It will depend on the product. It will depend on what we just went through. Where within the market are you selling and to what buyer group? But these are some of the high-level stats. Each of the tables will be formatted the same. Take a look at the first row. That's your year-over-year change in the sales rate. It's always going to start that way. And for most regions, you will find that the sales rate is down compared to last year. And I don't think anyone is surprised by that, especially given those national stats where we're showing where those total levels are. Then you look at that change from 2019. Again, 2019, healthy year. This is, hey, let's just get back to baseline. Let's get back to the level of growth we expected. When you look across the Pacific region, LA, Portland, San Diego, still above where they were 2019. Riverside, Sacramento down, San Francisco, Seattle down. Now I'm gonna look at those in 2 different chunks because I think those 2 markets can be clustered by having different drivers and different reasons why the market is changing. As you look at somewhere like Riverside and Sacramento, these were the affordability plays. These were when the pandemic hit, you could move a little bit inland, you could work from home, there were a lot of opportunities, bang for buck was there, made a lot of sense that those markets did really well. But then the spread, the value proposition has gone down as some people have returned to work and just as those prices have gone up really, really fast. So that's part of the reason we're seeing some of those markets slow. That links up with places like Vegas, Phoenix, Salt Lake City, Denver, Boise. Some of those other markets fall into that same category. Now, what we like to look at is quick move-in. Later in this presentation, I'll show the national quick move-in chart, but quick move-ins to us is that's the spec inventory, the standing inventory that's available right now. And as we're looking at that in a place like Sacramento, that's up 44% compared to 2019. And that is showing us that there's actually a buildup of inventory in that market, Riverside about flat. As we go throughout these markets, know that we look at that QMI very closely, and you'll hear me mention this more than once. The existence of a lot of QMIs will contribute to more dramatic price drops and a more dramatic use of incentives. Markets where you don't see as many QMIs, you'll probably still see some incentives and still see some price drops, but nowhere near to the same extent. Take a look at San Francisco and Seattle. Again, we're talking sales rate down. You're looking at the QMI still very notably compared to 2019. Now, again, you layer in QMI to total units under construction going down for Riverside and Sacramento, you're seeing total units under construction up between 60 and over 100%. If you look at San Francisco, Seattle, and maybe we're going to throw in LA, look at that change. You basically have total units under construction down or flat. And to me, those become interesting because San Francisco's number of total units under construction is so minuscule compared to the overall level of the market. Now, San Francisco does have their overall resale inventory flat to where it was last year, but you're not having that same buildup of QMI. Most of these markets still have resale inventory down compared to 2019. That matches the national level. That's not the same everywhere in the country, and you'll see some of the markets that stand out against this. In places like the Pacific region, you have some consumers that are unwilling to sell their home because they don't want to reset their property tax. And you have the same issue that you'll see across the country, which is the lock-in effect. Why do I want to sell my home and re-enter the market with a higher interest rate? Relocation buyers are a little bit of the exception because maybe they don't have to take out as much of a loan because they have equity. And again, that's playing into other parts of the Southeast. Now, as we look at some of our experts, Mark Zastowski is there in the Pacific, and he said that at first, actually, what's interesting, and contrary to the data that I showed, the luxury market slowed more notably. He's operating mostly in Seattle, and what he said, it was the existence of the NASDAQ turning down so quickly, and in those markets, actually wealth being impacted that drove that change. So again, when you look at San Francisco and Seattle, they are driven by wealth and they're driven by the stock market, more so of what we're seeing in Riverside and Sacto that are more driven by what we're seeing with incomes. Then you move to the Rocky Mountain region. And again, starting at that top line, you have the sales rate change down year over year. All of us would expect that. Change from 2019, these are pretty big numbers. So we are seeing some of these markets are slowing. For context, if you're operating in Boise, I'm sorry we don't have the Boise data here. We don't have all of these stats for Boise, so we chose to exclude it, but do know that Boise is following the same patterns of the market we're showing here. Now, in markets like this, we're seeing that the percent of projects with incentives is very high. This is higher than the national average, which is averaging a little over 50%. You can see in Denver, it's somewhere like 97%. Now, in a place like Denver, I just got new data this morning on that market, and the cancellation rate, which nationally is averaging about 20, in Denver, it's over 40. So it doesn't make sense to, it makes complete sense to me that the sales rate's down and also that the use of incentives is there to try to bolster some activity. When you look at QMIs, you are seeing that Salt Lake City, 231% change increase compared to where we were in 2019. Denver is actually a little bit down compared to where it was. We have a lot of units under construction, most notably in Vegas and Salt Lake City. And then again, take a look at that resale inventory. Still down in Denver, which is good. When you're looking at Las Vegas, you're actually up 12% in terms of resale inventory. Salt Lake City down 7%, but we're watching for that to change because you have inventory that's pretty close to 2019 with a large number of units under construction and a pretty massive existence of QMIs right now. As we look at this data, Tom Hayden is one of our experts in the mountain region, and he said that we're seeing a notable slowdown in starts right now in the Rocky region, just as builders are saying, okay, we know that there's units under construction. We know that demand is down a little bit. Let's just feel out how this market looks. And I think that matches up with some of the national data we got earlier this morning. When you look at the Southwest, and I promise this is the last one where you're not going to feel that good as I go through it until we switch over to the other regions. Again, top line, sales rate year over year, all of them down. Compared to 2019, Houston is outperforming. You can see Phoenix and Austin are the two markets that have the biggest drop compared to where they were in 2019, and also a lot of units under construction with an existence of QMI that's now above 2019. So for us, when you look across the country, we can say that the good news, and we'll talk about this later, is that we did not have overbuilding nationally for a lot of different reasons. In some markets, I think for a short period of time, you may see a potential inventory glut that does result in, again, those more dramatic price cuts and a heavier use of incentives. When you look at resale inventory here, to me, we're looking at Austin and Phoenix and Las Vegas as some of those where you are finding that resale inventory is above 2019. Again, not the same as the national trend, but it becomes local. Take a look at Dallas, Houston, San Antonio. You're still seeing resale inventory extremely constrained. Stephen Hensley is one of our experts across the Southwest, and he says right now it's really buyers and sellers trying to readjust to what the new normal is, what the market is, where the price of homes matches the level of demand for those homes. All right, let's move over to the Midwest. And as we look here, many of you know I was born and raised in Cleveland, so it's fun for me to talk about the Midwest. But you can see for that top line, it's not across the board that every market is even down year over year. When you look at where we were compared to 2019, you actually have the majority of the top markets that are outperforming 2019. Cincinnati and Columbus, you're seeing that those levels are down. Now, Cincinnati and Columbus also have QMI that's up compared to 2019. Same thing with Minneapolis. And as you look at somewhere like Columbus, I toured this market a few weeks ago, and I remember standing at one new home community and looking out the window, and the sales agent could literally point to the QMIs that were in the community that he knew he needed to sell quickly. So as we're looking at this, I think the biggest concern for builders right now in the Midwest, in some markets of the Midwest, is just, hey, let's just make sure that we can move this standing inventory relatively quickly. Resale inventory, though, look at those stats, still massively down. And one of the things that I heard talking to a builder in a different market in the Midwest is they said that what they're finding is it's this interesting dynamic where they were not immediately a winner of the pandemic from a relocation point of view. It was that more people were just looking to buy a home. It wasn't that everyone was coming in from out of market. What I'm now hearing is as some parts of the Southeast become expensive relative to what they used to be, there's actually some migration from the Southeast to the Midwest, because the Midwest still does have that bang for buck going for it, despite some of the changes that we've seen in home prices recently. So here we go to the Southeast then. So top line, you can see across the board, almost all of the markets down year over year. Second line, change from 2019, almost all of the markets up. So again, you can start to see that clear regional difference. As we look here, QMI down, 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 with the exception of pretty notable changes in Jacksonville and Louisville. Jacksonville, as we're looking at this, we're also looking at those total units under construction. So on a relative basis, just a little bit more developable land. But as we're looking at this again, take a look at the resale inventory, still very, very low on that bottom line. And our expert, Andrew Wilson, is talking about how there's migration, lifestyle changes, diversified employment opportunities that are helping support some of the growth in the Southeast. Ultimately, though, the one thing I will say is while this market held up a lot better than most other markets and is outperforming compared to history, watch this third column down that I just dropped in this bracket. I'll do it again. That is looking at the change in the monthly payment since the end of last year, assuming a 6% interest rate, not assuming a 7% interest rate. So as we're looking at this, you can see really massive changes in that monthly payment that have not translated into dramatically slower sales, at least at this point. One quick note for the team on the call, if you can just make sure that everyone's muted, that would be great. As we're looking here then at our final region, the Northeast, and in the Northeast, what you can see is a couple of the main markets, New York, Washington, DC, Philadelphia. Looking down here, DC stands out for being the slowest from a sales rate point of view, holding up relatively well with that sales rate for New York and Philadelphia. QMI between flat to down, total units under construction, not a massive number. And I think that's really one of the biggest takeaways of the Northeast, is because there is not that much developable land, because it is more land bound, they're older cities, they have older homes. there's not that many units under construction. It's what we call, frankly, a bit more of a boring market. It's not as boomy and busty as some other markets as you would see. And you have a lot of constraints on that resale inventory where existing homeowners are just not that willing to put their home on the market. Doesn't mean we aren't seeing incentives and price cuts. We absolutely are. But I think there's a lot more belief that this market becomes more durable and more sustainable than some of the other ones that we talked about. So at that point, we've already covered a lot, but I want to then take the discussion point to almost all of the regions show that year-over-year sales were down. It was very variable if we're talking about down compared to 2019 or not. But the question is, if the market has, or since the market has slowed, how are builders responding, knowing that our business is to build homes and sell homes? And one of the big things that we're seeing is those use of incentives are still extremely common. Like I said, I would show you the September data, but also layer in our new stuff for October. We had 75% of builders that reported increasing their incentives in the month of September. Our preliminary data for mid-month October is now 83%. So you're seeing again that those incentives are common across the board, whether it's the rate buy down, either the adjustable version or the 30-year fixed version, money towards closing costs that become important to consumers as they're trying to watch their cash to close and how much of a down payment they can do and how that plays into the monthly payment. And then we're seeing money towards the options and upgrades. When you look at pricing becomes a really interesting story because remember what we talked about, the first slide that we talked about, which was preserving backlog. We know how important that is for the massive number of units that are under construction right now. We'll talk about that in a moment. But we know that builders are also saying, okay, if incentives aren't enough, we also will do some changes to pricing to help drive demand. So for context, if you guys remember at the beginning of this year when we did this presentation together with BFS, we knew that 97% of builders were raising prices. And now we're at a point that about 5% of builders are raising prices. 64% are holding prices flat. So they are where they are, and maybe they're going to do a little bit of incentive, but not going to move that dramatically. As of September, we had 28% of builders that had lower base prices. Again, our data for September shows it's now 38%. So you are seeing lowering base prices becomes more common. And it's usually because one builder in the market within maybe your competitive landscape has cut prices, and then it kind of forces the hand of some of the other builders within the area. Now, the main reason that we are seeing price cuts will be because, again, like I said, just the existence of QMI and just, okay, let's try to move some of the product that we know is available to consumers, at least within the next 90 days. So national quick move-in data, we collect this every week. You can see that we're now above 2019, 2020. We haven't been above recently, but we just crossed over. But as we look at this, know that that's not a dramatically high number. That national number does not keep me up at night. That feels very much in check, very much in line with what seems to be a more normal and healthy market. Again, as we're looking at the QMIs, we're really looking at the extent to which it built up quickly and the extent to which it looks out of line with what a more normal market might look like. You heard me reference a few times the active listings number on a national stat. So I just wanted to show this to you because I mentioned it. Look at that mint line on the left-hand chart. That's looking at the 2022 active listings. It was good because we were seeing this number go up, and what we want is more active listings. When you have more inventory, you can have more health in the market. You do have more people that are willing to move. It does show more transactions, and we're seeing that that level did increase, and now it's flattening off. I think as some people say, well, maybe I'm going to wait until spring selling season, or maybe I'm going to wait till mortgage rates go down, or maybe I'm happy enough with my home that I'm willing to stay put. We're seeing that those levels have leveled off. Again, that's a national level, pretty notably below where we were going into the pandemic. Those are those top three lines that you can see on the national chart. On the right-hand side shows you the year-over-year change and change from 2019 by market. We already covered that at length when we went through those regional comparisons. So as we look at all of this, we talked about QMI, we talked about listings, but we also want to talk about what is coming down the pipeline. What do we know is likely going to happen with starts, and what are we seeing with total units under construction? And the first thing that we should acknowledge, and the first thing that we know, is that historically, when sales slow, starts slow. It makes total sense. We see that going back to the 1970s, you have a 3 to 6 month, really 3 to 7 month lag from when the market slows to where you see start slow. That's, I think, a given, and we're already seeing that on the ground. So we saw today, we got the new single family units coming out. You can see that we're off the high levels that we were at over the past couple of years. Putting it back to context, that to me is always so important. Year-over-year changes will be one number. Looking at where we were from a historical point of view becomes important. Put you back to 2019. What did we talk about through the length of today's presentation? It was a lot of sales returning to 2019. It would make perfect sense to me that you also see starts returning to that level, especially as you have builders that are saying, we shifted to a more spec heavy strategy because we were trying to control for cost, because we were trying to control for when those homes would be built. Now we're going back to be built, taking orders of consumers that want to just pick their home, because that just maybe makes more sense to align up those starts and sales levels. Now, as we look at this though, like I said, I think context becomes really important. This is looking at those starts going back to the year 2000. And what gives me a lot of comfort is if you think about last cycle and you think about for how long we had so many units that were under construction, this was year after year after year, we had a really accelerated cycle this time around. We had the total units that were being built only lasted at a high level for 2 years, but you can see even that high level looks minuscule compared to what we saw last cycle. So as we're seeing the adjustment, I also think when your mind goes back to, okay, the market feels slow, you need to remember to put these in context of what was it like last cycle, how many units, how long, versus what we've seen this year, or I guess the past couple of years. Now, as we're looking at the starts are different than the number of units that are under construction. This number is near a record high, but remembering why is important as well. It's largely because of those longer cycle times that are still impacting the market, though not as discussed as commonly as they once were. We know that builders were rushing to try to meet demand, and we know that that resulted in a large number of units that are still under construction right now. So going back to preserving backlog, which I think is kind of a third theme of today's presentation, we know that there are a lot of units where there probably are consumers tied to these homes, and if not, they're homes that ultimately turn into that QMI. But as we look at those longer cycle times, I think the question is, well, how long is this going to last? Are we still having all of the same challenges? And the answer is broadly yes, though a little bit of an improvement, but I think that is a very relative term. When we look at government services, we have 62% of builders that are still saying that's a massive issue. 56% are saying land disruptions, 58% saying labor. Now, I think this is a really interesting number because as we looked back over this year, we got to a record high of 80% of builders that were saying they were having a massive labor shortage and it was causing a big issue. So we went from 80% to 60%. 60% is still extremely high, extremely elevated. But what we're hearing on the ground is some builders are saying, well, because we're not starting as many homes, we're not having as severe of a labor shortage as we did have. It's still there, still absolutely an issue. It just seems like it's getting a little bit better. And I would say the same thing for the supply disruptions. We had month after month after month of over 90% of builders saying that supply disruptions were just causing an absolute headache. We still know on the ground it's whack-a-mole. We still know that it's not easy to do business. We still know that the supply disruptions are there. I think the good news is at least directionally, we're not talking 95% of builders anymore. We're talking 72%. As we look at this, the components that go into a home that are shifting and causing the biggest headaches are different than what they were. I think at the beginning of the pandemic, it was some of those early components to getting the homes built. What we're looking at today, it's some of those last touch items, which they have been pretty similar over the past handful of months, where it's HVAC equipment, windows and doors, appliances, and cabinets. These are some of the components that builders are saying are impacting their cycle times the most severely. And as we look at this, and as we say, okay, we went from 95% of builders saying supply chain issues to 72%. And wow, it seems like some of the components are getting maybe a little bit easier to source. I think there's a little bit of a misunderstanding about some of the trends that are happening from a construction material point of view. Because it's a very similar trend where at the beginning of this year, there was the producer price index, the PPI for construction materials. This is a measure of construction costs. It was up 35% compared to where it was last year. Where we're looking at today, we're saying that it's up 9%. So yes, the rate of growth in construction materials has come down. When you're looking at that though, know that that 9% is off a higher base level. So we're still seeing that construction materials are a massive part of the equation of trying to figure out what can happen with home prices and how the market moves forward. The trend is good. I think we want to see that we're not still up 35% year over year. We're not consistently seeing that high of a number, but know the wild cards. Wild cards being that there are still COVID shutdowns in China. I just got home from Asia yesterday, and I will say they still take COVID extremely seriously. And so we are watching that. And then also the ports. We know that the Port of Los Angeles has come out and warned of additional headaches. So while it seems that some of the supply chain is at least moving in the right direction, we know that there are still some risks to this. So looking at all of this and rolling it together, we started this section by saying that when sales slow, you expect to see start slow, and we're already seeing that on the ground. And then we're layering into what that might look like for the rest of this year and going into next year. Now, I don't have the exact stats for October, but I eyeballed the numbers before joining this webinar, and they look very similar in October to September, where we have about a little over 80% of builders that are continuing to plan to slow starts through the balance of this year. As we go into next year, you see a similar thing. Not as many builders reporting significantly slowing starts, but still you have about 50% that are saying slightly slowing and 34% saying significantly slowing, 20% that are saying not planning to slow starts at all. And that could be regional, that could be them trying to gain market share, that could be them trying to position for when the market does come out on the other side. But we're tracking obviously what happens with the starts activity as we go into next year. So final section here, and I'll tell the BFS team that it's probably only going to take me a minute or two to get through this, and then we'll start to take questions after that. So call again to the attendees. If you do have any questions either for myself or the BFS team, please feel free to submit those so we can address them before this webinar is over. So final thoughts. I think I've spent a lot of time talking about buyers and buyers trying to make sense of today's market. I have been on the road every week now for the past 6 weeks, going to different housing markets across the country. And if any of you have ever talked to me, sometimes I ask really personal questions that people don't like to answer, but that's a big thing I want to do is layer in the data that we're collecting with qualitative information. And I can't tell you the amount of younger people that I've met on the road that have said that they want to buy a home. And for one reason or another, whether it's that 7% mortgage rate has just crushed it for them, or they just are not certain where the market's going, they're sitting on the sidelines. To me, I do feel encouraged by that. Even though it isn't translating into sales activity right now, it does still tell us about this potential buyer pool that's sitting on the sidelines. But we know that that headline effect is playing into it. Now, when you look at the BTR market, this is one thing that builders are considering a lot. BTR meaning either builders are strategically shifting to built to rent, or with some of that standing inventory, trying to sell that off to some investors. My coworker, Tim Sullivan, has spent extensive time looking at the BTR market. We know that that's shifting. We know the appetite is shifting and changing, and there's a lot of moving parts there. We know that the why becomes important. I talked about the lock-in effect. We know that the lock-in effect is really a hindrance to some consumers. If we have 90% of people that have a mortgage rate under 5%, why do they want to move? Well, the answer is sometimes, like I said, some people don't care about interest rates. Sometimes you have to, whether it's divorce, whether it's marriage, whether it's having kids, moving from one market to another. There are still whys, and it's figuring out how to be well positioned in the event of that move that helps us be successful. And ultimately, we know, and I think last time we talked about the shift from taking orders to selling. When you think about that, you go back to the consumer research. If you're going to change your product, if you're going to do more attached or smaller square footage or larger square footage or down spec or up spec, where should you be spending your time? Where should you be spending your money? Going back to the 101s of building homes and thinking about and focusing on that consumer research has become, I would say, more important than ever as we look at today's market. So with that, I will stop sharing, and Mike, let me pass it back to you.
Allie, thank you so much. That was a lot of really good information, and we appreciate you working through that for us. I'm sure we're going to get lots of good questions after that, but Before we get to the Q&A section, I wanted to introduce Steve LaValley, who's our VP of Forest Products and Transportation. Steve?
Great, thanks, Mike, and thanks, Allie. It's always a tough act to follow. So I just want to take a minute to kind of reflect back on some of the comments that Terry made earlier regarding the ReadyFrame. First of all, Terry, thanks for your passion around ReadyFrame and the benefits it brings to the builders and the industry as a whole. Specific to the commodity lumber, I can say that these benefits also extend directly to the efficiency and utilization of raw resources, lumber and I guess all the forest products as a whole. Our BFS ReadyFrame locations, I know from the procurement side of the business, as having responsibility of the procurement side of the business, I can tell you our ReadyFrame locations are highly efficient and responsible consumers of lumber and can often better utilize the products and tally profiles that the mills produce. And so I can say that our optimizers do reduce waste, and we definitely see this on the procurement side of the business as well. Hopefully the builder can see this translate to less waste and scrap on the job site. So the technologies like the ReadyFrame, panelization, and Ready Trusses are a highly efficient use of the natural resources. And so thinking about, speaking of the lumber and the structural panels though, certainly the markets have felt the impact of headwinds in housing and construction. Prices are well off their peaks that we saw earlier this year and last year. So this slowing demand causes an apparent shift in the supply and demand balance. But let's talk through what this really is. So OSB and lumber appears more abundant, but only relative to current demand. Transportation appears more abundant, but only relative to current demand. So similar to some of Allie's comments there. In fact, the actual supply of both is really no different than what it was last year or even earlier this year. So when we find housing starts begin to rebound eventually at some point, the scenario from the last 2 years could very well rear its head once again. So this is where efficient use of the fiber should be important to all of us. And I think we're ReadyFrame and some of these panelization, wall panels, floor, roof trusses come back into play. So for me, a lot of the questions for me often come about regarding price. And so yes, commodity prices are lower today, but where will they go next? And so I try not to predict future prices necessarily, but I think we can say that the cost structure for everybody in the industry is higher than it was just a couple of years ago. So inflation in fuel, inflation in energy, inflation in labor, and logs, rail, all sorts of other fixed and variable expense. So I think it's reasonable to expect that the floor price at which the producers begin to curtail production will be higher than what we were used to back in 2019 or before. So be cautious with any expectation of prices falling much lower in 2023 than we're looking at today. So there's my price prediction. Next slide there. Which makes me think about, I saw this just yesterday. I was looking at some of the FEA information that they provide, and I just thought this is a good illustration of this exact point. And so we can see where the recent market levels on the bottom right reached what, let's say, the cost of production could be. So hopefully all of this can give everybody a reminder that slower markets don't always mean lower prices. Yes, we have lower prices today than we had over the last year or two, but as the costs or as the price of lumber and cheap goods approaches the cost of production, we could very well start to see curtailments in the industry. And so if there is any uptick in the near term of housing demand, we could quickly find ourselves back in a similar scenario that we just saw the last year or two. So don't get too complacent on your pricing forecasts. You get the trading prices that quickly approach the cost of production of these products. So on that note, I'll turn it over to Jeff. Take it away.
Well, thanks, Steve. Everyone, I'll cover some of our building products real quick. Availability on next slide, Jack. Let's see. Availability is steadily improving in some of the building products. Both James Hardie and LP SmartSide have additional production coming online, and availability will continue to improve over the next 2 quarters. As Ali referenced, with the slower housing starts back to 2019 levels, we are seeing the availability of I-joists already come back in line with traditional lead times, and we expect to see LVL lead times come back in line with historical expectations over the next few quarters. BFS continues to add production capacity across the nation for our truss plants, and lead times for both roof and open web floor trusses continue to come down. And as Terry mentioned already, we continue to add ReadyFrame sites and capacity across the nation. Next slide, Jack. As we turn to millwork, vinyl window suppliers are in a much better spot than they were earlier this year. Factory capacity has been added, and labor has been steady. This has allowed the backlog for many suppliers to be worked down to under 9 weeks, and in some cases, even 4 to 5 weeks. Wood window suppliers have also seen some improvements. Most lead times are better, but still extended above normal historical levels. Wood window capacity has not been as flexible as vinyl suppliers, and consequently are taking a longer time to recover. The big challenge for the wood window industry, as well as all windows, continues to be glass. Other materials and components have stabilized, but glass is in tight demand, notably large glass for direct sets and patio doors. This is due to a shortage in the U.S. float glass capacity and competing industries like solar panels taking additional allocation. BFS highly recommends planning and confirming lead times before starting any new projects. Lastly, we continue to see increased production around interior and exterior doors, with lead times and fill rates both improving. As we have mentioned before, please continue to work with your BFS sales professionals in helping plan your projects to ensure a consistent product flow. With that, I'll turn it back over to Allie to answer some of the questions she's received so far.
Awesome. Thanks, Jeff. And it seems like a lot of the questions that have come in are just definitions for what I presented. So I'm sorry if you were listening to the presentation and you were frustrated that you didn't know what some of these phrases were. So again, QMI was quick move-in inventory. You would know it also as standing inventory, speculative inventory. Those are homes that can be moved into within 90 days. The QMI change that I showed, I think I was showing the year-over-year change and the change from 2019 levels. When we look at the sales rate, we're looking at sales rate as the average sales per month per community. This is looking at a contract sale. And instead of looking at total sales, we'd like the average sales rate because it adjusts for how many communities are available. If you look at total sales activity, oftentimes that's going to be down almost just as a function of supply. So we're trying to take that component out of it. Now, as I look at some of the other questions, let me see. Yes, we do have a forecast for 2023 housing starts, and we will have that on our webinar later this month for Zonda, so you can join that if you're interested. Let's see. Okay, does the resale inventory signal that the remodeling market should stay strong since those numbers appear to be less affected than the housing starts number? This is a great question, and we have an expert in-house. His name is Todd Tamilak, and his focus is 100% remodeling. That's all he does day in and day out. And for Todd's forecast, he breaks out the remodeling sector into 3 different sections. He looks at the lowest category, lowest price point, mid, and high end. You can send me an email. I don't have memorized what the 3 different price points was, but I remember low end is like repair and maintenance, and the high end would be something like HDTV, and then you have the middle category, which is exactly what it sounds in between those two. He does think that for most of those categories, we do see that the remodeling softens a little bit over the next couple of years. He does see that the growth comes down a little bit, but he calls this period over the next 5 to 10 years the golden years for remodeling. So he thinks that remodeling is not 100% immune to any kind of economic uncertainty, any kind of economic recession, any kind of job losses, any kind of change in home equity. He's trying to not ignore that there may be some of those broader macro pictures that play into remodeling, but he does still see that remodeling becomes a positive component. Jack, I'm going to take one more question here, and I'll turn back to you to see if there is any questions for the BFS team. The last question that I will address real quickly is, what impact does the midterm elections have on the housing market? And what we can tell you is if you look at both the general election and for midterm elections going back, I think we go back 30 or 50 years, I can't remember how long we do it, but you will find that if you look at the non-seasonally adjusted monthly number in the month of an election, whether general or midterm, more notably in general than midterm, you do see that sales come down a little bit more than what you would normally imagine for that month. So there is a little bit of an uncertainty hit, but it's almost always very concentrated on that 1 month. So you don't see that it's spread across, 4 or 5 months where people are uncertain. It's people go through that shock and then they get back to business as usual. So Jack, let me turn it over to you and see if there's any questions for your team.
You bet. Thank you very much, Allie. This is Jack Madden, Director of Marketing and Communications. So first question was to to Jeff Rettig here in regards to EWP. Is there any potential price relief for manufacturers on the engineered wood side? This person is getting asked daily from customers as it relates to EWP to commodity lumber.
I think we're going to see a lot of price fluctuations over the next couple quarters, Jack. As Steve mentioned, the thing that we need to remember though is labor rates, energy rates, and everything are still hitting our manufacturers pretty hard. But they are looking to see where they can help us out at, and are looking at market specific. So I think over the next 2 quarters, you'll probably see some fluctuations out there.
Excellent. Next question. It's regarding lumber. As the dollar stays strong and the U.S. import is appealing, we're seeing more European lumber, 2x4s and 2x6s available in the market. Will this dynamic help manage futures pricing from traditional sources, thus helping manage pricing through March?
Yep. Thanks, Jack. I'll take that one on lumber. I think the question is, is there going to be more European lumber? That's hard to say. We're not necessarily seeing it yet. Yes, a strong dollar could attract more of that. And so I guess time will tell on that. I think the important piece on that is just to remember that in certain parts of the country, European imports can be a significant piece of the supply in the market. But when looking at the country as a whole, if you got a 53 billion foot industry, 1.5 billion feet, it's not going to increase significant enough to weigh to skew the overall pricing structure.
Excellent. Thank you very much. And with that, Ali, I just messaged you 2 more questions that came in there.
Okay, great. Thanks, Jack. So the 2 questions that came through, one is, when do you think that the numbers, data by Metro, take into account the full effect of interest rate increases? So let me answer this by going back. So I showed you that the public data right now is going to be through August. If you think back to August, in August, we were averaging a little over a 5% interest rate. 5% was down from June and July, where we got to 6%. So I think the data for August is showing, okay, this is how a market has responded at 5%. When we look into September, we're at Zonda, we'll release our data next week for September. I think the same thing with the census data. That now has a market that averaged 6% interest rate. So you should expect that that data is going to maybe look a little bit different because the interest rates have gone up. Now where we're sitting here in October, the most recent data, I know the Freddie Mac came out last week, just under 7%. I know real time talking to loan officers this morning, it's averaging over 7%. So the answer is, it is fluctuating very much by month, by week. We're seeing it change and consumers respond. To piggyback onto the next question, which was, were there builder incentives back in 2019, or was that considered a more normal market? What we're finding is, one thing to wrap up that first question is, we are finding that for the most part, consumers are responding to changes in the rate buy downs or changes in the incentives or changes in the pricing that I think can help offset a little bit of those interest rates. But at 7%, you know that it's got to be pretty aggressive at this point. When you look at 2019, the answer is yes, there were incentives. I wouldn't say that the prevalence, the existence, the dollar amount, the share was as high as what we're seeing today. So I think that's a good question where so much of my discussion point was back to 2019. It does seem like right now the incentives are being used to drive activity back to 2019. There were incentives back then, but like I said, they weren't as widespread. I think, oh, okay, the last, oh no, let me just turn it back to Mike. We're at 11, or 11 Pacific. So Mike, let me turn it to you.
Yeah, thank you so much, Ali and Terry and Jeff and Steve. Thank you for all your information on today's call. One last time, I'd just like to thank everybody for joining this call, and hopefully the information was helpful to everybody. And we wish you a great day. Thank you.